fundsupermart.com.
Hi Toby, what are the benefits and investment case for multi-asset investing?
Well, multi-asset investing is sometimes sold in a way in which people don't like something, so they choose a broad, diversified basket of assets. We actually do like a lot of things. We think that in the long term, equity markets offer a really interesting risk premium. But in the short term, they can be hugely volatile. And so we're trying to really manage the level of volatility to provide a much smoother ride, participate in the upside of markets, but then provide some downside protection. And so a really good multi-asset product should be able to provide that downside protection and smooth that ride.
Since correlation coefficients between asset classes are not readily available to most investors, naive diversification is the most common approach used. Is this sufficient, and what should investors look out for to ensure their portfolios are sufficiently diversified?
Well, diversification is famously a great free lunch. But I think during the global financial crisis, a lot of people realized that actually by putting money into lots of things which had different labels didn't provide great levels of diversification. So how much diversification do you get from spreading your assets geographically among equity market? Well, not a lot. Given that there was a lot of credit coming that was linking up markets on the high yield side, on the equity side, on the loan side, again, that diversification, although it might have looked like a sensible idea in terms of different asset classes, didn't really provide that level of diversification. So it's really important to think about what is connecting asset classes, what is driving them together. And for that, I think you need quite a lot of research and analytics, and thinking about combining these things intelligently in a portfolio basis. It requires quite a lot of, I think a lot of work. And we try and do that work for investors to provide something which provides genuine diversification.
What is your current view on the markets? What are the risks and opportunities presented by the different asset classes?
Well, our view on economics is quite gloomy, but that doesn't necessarily translate into a hugely gloomy view on markets. We see government bond yields in a variety of core areas at very low levels, providing very little downside protection to portfolios. But we see relatively normal levels of risk premium in equity markets, and we want to capture some of that risk premium. Now, combining a static level of fixed income and equity, although it's worked quite well in the past in providing that downside protection, we think it's going to do less well in the future. So the things we're looking to do are reduce some of our equity exposure, reduce some of our core government bond exposure, and increase levels into things like high yield credit, into emerging market foreign exchange, into commodities to benefit from asset reflation that we believe is underway with central banks around the world focused on this. And combining these things in such a way we think will lead to superior risk-adjusted returns.
Can you briefly share with us the asset allocation decision-making process within Threadneedle?
Well, the process is relatively long and involved because there are 140 investment professionals that are putting into this. The process is typically one of research, then strategy, then portfolio construction. And on the research side, we're really thinking about, first of all, what's happening in the world. What's going on from the top down, from the bottom up, from sectoral ways. And we put a huge amount of effort into getting that right. And sometimes it's very tempting to feel that when you have a strong view about what's going to happen in the world, that should automatically result in a good investment view. But unfortunately, that's not the case. So we put a lot of emphasis also on valuation research, understanding exactly what's discounted by markets. So what's discounted by central bank policy rates, by credit markets, by equity markets. To give you an example, I have a very high certainty that the Federal Reserve is not going to increase interest rates next year. But that doesn't translate into an investment view because it's completely discounted by markets. So by looking first of all on what we think is going to happen, then what's priced to happen, and then thinking about the disconnect between those two provides us the opportunities to allocate where there are genuine opportunities and work hard for our clients that way.
Thank you.
Thank you.